Today, I'm going to be going over my decision to add Wendy's to my portfolio. This video and stock purchase was kind of fun because it is the first company I've added to my portfolio that I really just had to go in and assess whether the stock was a yield trap or not. I'm not going to get into the business of the company too much in this video because I am assuming the majority of viewers have heard of Wendy's. Now, if you look at the dividend yield for this stock, it shows at 9.06% right now. This isn't really accurate as the company recently cut its dividend from $1 a share annually to 56 cents a share annually. This still leaves that yield fairly attractive at roughly like 5.6%. Now, anytime a company goes and cuts its dividend, I'm not really thrilled. After all, the goal of this portfolio is to generate dividends while the company's stocks still increase or maintain value at the very least. When a company cuts its dividend, it usually indicates stuff isn't going well. And looking from the stock price chart, you can see the market really isn't taking the dividend cut and the performance of the company so far very well as well. It hasn't been a great 5 years, to say the least. So pulling up the most recent 10K for starters, I'll get into the quarter one stuff in a minute, but you'll see the revenue has been increasing each year with expenses increasing as well at a slightly bigger pace in 2024. So you'll see the net income and earnings per share actually took a bit of a dip in 2024, which isn't great, but it wasn't too drastic of a drop. Still not good though. The big thing I wanted to point out here is the earnings per share in relation to that previous dividend payout I mentioned. So you can look in 2024, the diluted earnings per share was 95 cents a share. In 2023, it was 97 cents a share. And then in 2022, it was 82 cents a share. Now, they only really raised that dividend in 2023. I want to say the annual dividend in 2022 was like 50 cents in a share, but in 2023, the company decided to double the dividend. Now, the earnings per share and free cash flow definitely did improve from 2022 to 2023, but it didn't double. So, for whatever reason, people at the company decided to double that previous dividend, which really put some pressure on the company and caused its payout ratio to be quite high. As a percentage of earnings per share, the dividend payout ratio was roughly 103 and 105% in 2023 and 2024, respectively. This is an issue because not only does this increase the risk that the company has to cut the dividend if its earnings decrease, like we saw that slight decrease in 2024, but it also really just limits the company's ability to reinvest cash into the business. I like getting a dividend. I like the company just performing well, being able to throw off cash consistently. But if the dividend's done at the cost of being able to reinvest in the business at all, and I don't love that just because then that really increases the risk that if there's a downturn at all, or if the company isn't growing and just improving, then likes of me getting a dividend increase down the road are pretty slim. So for 2025, management cut its original forecast slightly and is projecting adjusted earnings per share from like 92 to 98 cents for 2025. This will put the payout ratio anywhere from like 57 to 61% based on that new dividend. So while I think the dividend cut is unfortunate, I don't really think it made sense for that dividend to be that high in the first place. The lower dividend, in theory, should be safer from a cut and provide more opportunity for the company to really just focus on growth. Now, looking over at the restaurant openings and closings, the last several years, the company has steadily opened new restaurants, net new restaurants each year. In 2024, it was a bit of a different story. Every year, the company or a franchisee, they will close some restaurants, typically if there's underperforming locations. That's something that just happens in the restaurant business. Um, but in 2024, they closed a significant amount of locations, and they actually ended up with zero net new restaurants. Luckily, through the first quarter of the year, Wendy's has added 68 net new locations, which should help growth going forward. Wendy's has stated it's focused on growth with the goal of 8,200 locations by 2028 and an improvement in EBITDA, just as it has more locations and really just hopes the company returns to some just good same stores sales growth as well. The worry of how well this will all be executed, I mean, there that is a concern. I just don't want them to go opening restaurants everywhere if we're going to run into issues with them closing, but kind of leaving this up to their judgment. I'm hoping that I'm personally excited, at least at the very least, they are going to be attempting to open new restaurants, which I think is better than just not opening any and then closing some down. So the new restaurant openings I am excited about because it really should lead to some improvement in the health of the company overall. Now, on to quarter one of 2025. Now, the quarter two earnings report will be coming out in a couple of days, and I'll definitely be taking a look at that. Quarter one was pretty rough. Revenue and income were down for the quarter year over year. We saw same stores sales growth actually be negative, which isn't good. Just when you're looking at the revenue of a restaurant, you typically want it to go up year over year, especially with inflation and everything, not going down. Some of this is just due to the economic environment. The fast food industries kind of they had a rough quarter one. McDonald's saw same kind of decrease. McDonald's just reported their quarter two earnings, and it actually reported pretty good like take up. It recovered from that decline. So while I'm not saying Wendy's is going to end up in that same situation, at the very least, I don't think we should be see another just big decline. I think some of that economic stability that might stabilize a bit, and then just hopefully with it, Wendy's marketing efforts, they're able to get same store sales growth to at least flatline or continue to grow as originally projected. So while the quarter one results weren't great, they weren't absolutely terrible either. Year over year, there definitely was a decline in revenue as well as net income, but it's not this giant number, everything's falling apart. So that same store's sales revenue and decline, it's never a good thing. But between the new restaurant locations and then Wendy's just continuing to try and innovate with new, like they did the new Frosty flavors earlier this year, and then they've done a couple of collaborations with Takis, and then the one that they just started with the Wednesday show. Wendy's is continuing to try and drive increased traffic and generate sales. So they're at least making an effort, and this is why with that dividend cut, I think they have some capital to try and continue to grow new stores, invest in the business. Hopefully, we can kind of see that growth going forward. Overall, a dividend cut's never thrilling, but I feel like the management has sort of got some things figured out and is reprioritizing on growth. Long term, I think this is going to help the company. Changes were needed. They couldn't just continue on that trajectory. Earnings weren't doing anything great, and they were just paying basically everything out. I purchased some Wendy's stock at the end of June and bought a little more at the end of July. I'm pretty close to the most exposure I would want to have on this company, but I could buy a few more shares if I like what I see from the company during this next quarter. If the company continues to just have a decline in sales or further cuts or eliminates that dividend, then I'd be pretty concerned. But as of now, I feel pretty comfortable with the company. I'm really thinking they should be able to turn around in the next couple of quarters. Quarter two, I think it could be maybe a flat quarter or just slight increase over quarter one for sure. And then I think quarter three, hopefully, we should start seeing a bit more of a recovery. But thanks for watching. Let me know what your thoughts are.